This is a graph of the US stock market, the S&P 500 for this year, and we are now down officially 20%. This has been a challenging time for many asset classes. We're going to spend some time talking about that and discussing what has occurred across asset classes, as well as some of the outlooks. Now, it is abnormal to see this, and kind of one of our themes last time we talked about this too. It is abnormal to see this much red across the screen. Typically, we do see asset classes like bonds versus stocks kind of offset each other in different markets. But now here we're zooming in on just one quarter, and we do see, and this has occurred in the past, albeit not often, where stocks, bonds, and commodities and real estate, they all kind of correlated and moved together to the downside. All right, now let's jump into inflation. Again, this report just came out this morning. We saw it was about 9.1%, with energy, shelter, and food were the biggest contributors to inflation levels. I'd say the biggest takeaway from the financial markets from this is that the financial markets are now expecting the Federal Reserve to be more aggressive than they have been. Okay, so inflation, we're measuring prices of goods over time. This is on a year-over-year basis. The Federal Reserve has a mandate, or one of their mandates is to help control inflation or control prices. Now, what they're going to be doing, have been doing, they've been increasing short-term interest rates. Consumer sentiment is at an all-time low. By the way, consumer sentiment, it measures how people, it's a survey that goes out and measures how optimistic consumers feel about their finances and the state of the economy. Now, this is a bit of a contrarian indicator, meaning that when it looks really bad, the stock market historically has actually tended to start to rebound and recover. And we think it makes worthwhile to talk about what does that mean for the stock market going forward, and looking at what does it mean when this happened in the past. Now, what we did is we took a step further to say, let's take a look at this from the bear market, from that down 20% threshold. Let's take a look at from there down to when did the bottom actually occur. All right. And what we found with that is that it took about 34 days on a median basis, or 129 days on an average basis. That's what we're looking at here on this graph. A bear market with no recession, on average, they're down about 28, 29%. Bear markets with a recession, right, that's down about 32%. They're both down a lot. They're both painful. We know that. But the difference between those two is not a great deal different. Okay, where the difference occurs and where it matters more is looking at the duration, or the time period of how long that drawdown period occurs, or how long it lasts for. And that's where we see that a bear market without a recession, it tends to be a little over 200 days, 218 days to be exact. That's on average. However, if we have a bear market with a recession, this is where we get to that point of, I mentioned on the prior slide, there's a big difference. It's because here we're looking at saying a bear market with a recession tends to be more prolonged. What that tells us or shows us, though, is that valuations, because we've seen this kind of reset in the bond market, that for investments on a go forward, we're seeing some rather attractive levels of bond yields, levels that we haven't seen for quite some time. Switching over to the stock market, valuations in the stock market are back to long-term averages. The graph we're looking at here, this is valuations using a price earnings multiple basis. This is not prices, this is valuations. So as the valuations have come down, it tells us that companies are in aggregate closer to kind of their average or fair valuations, or they're more attractively priced than they were a while back. We put up a sample portfolio. It does say Hubble versus the James Webb Telescope, where it's a bit of a joke on the Hubble versus the James Webb. This is not what the Hubble or the James Webb Telescope looks like. This is a sample client portfolio in an overall investment mix. What we find is that over time, on the left, it's blurred out. It's a bit like the Hubble. But what we find is that over time, as asset classes and markets move around, that investment mix portfolios get out of weight or out of alignment with what the long-term target is. And an area of focus right now is on making sure that portfolios are aligned with the long-term target. That requires rebalancing, selling investments, repositioning to other investments, and it's a mechanism that creates a buying low when prices are low process. The next thing I want to talk about is tax loss swapping. Tax loss swapping involves selling an investment that has an unrealized capital loss and swapping those dollars to a similar investment, right? Now, the benefit here is that that loss, that unrealized capital loss, becomes realized from a tax perspective. So it helps lower future tax implications or tax bills, but we can still maintain a similar investment mix. Losses can be carried forward under current tax law. We can carry forward capital losses into the future. It's saying the short term inflation doesn't feel good, but doesn't hurt a financial plan in the short term. It hurts it mostly in the long term. What that tells us then is that over the long term, we need to have and own, investors should have or own assets that are able to keep pace with inflation. Now, if we back into what those things are, stocks tend to be assets that keep pace with inflation over the long term, right? Q1 and Q2 this year was not the case, but if you were to stretch out and draw lines over long term, stock investments tend to keep pace. The reason that is, and this applies to other types of assets too, but assets that are more finite in supply. Right, over the next 10 to 15 years or 16 plus years, this is the area out here. This is the segment where we say, here's where we get to go on the offense. Here's where we rebalance. Here's where we're tax loss swapping. Here's where we have the opportunity to put more money to work to kind of, again, to make help portfolios be stronger coming out of this, to help recover out of this decline quicker. The front end, this is about stability and playing defense. And we kind of think about it in those two worlds, because again, there's too much uncertainty. There's too much uncertainty in the short term. It's not worth taking the risks, and whether it's in stocks or whatever in the short term. It's out here where time is on our side.